crude oil and refined product prices are looking to rebound from some of the steep drops that we saw recently. In fact, prices reached an annual low on Black Friday. Some of the reasons behind the recent drop is sanctions on Iran. The U.S. has issued some waivers for countries that can continue to import Iranian crude oil. That's only for a temporary amount of time. Equities markets also have dropped, and oil and equities have been moving pretty close to one another recently. Also, you have refinery maintenance that's allowed for inventories to rebuild. In fact, over the last 10 weeks, U.S. crude oil inventories have grown, and over that time, they've gone from a deficit of about 30 million barrels to last year, to the 5-year average rather, to a surplus of almost 16 million barrels. So oil inventories have recovered quite nicely, not just in the U.S. but globally. And now all eyes will turn to OPEC as they are preparing to meet, and most of the market is expecting a drop in production from them. They'll pull back on output somewhere probably in the 1 to 1.5 million barrel a day area. That should help the market recover a little bit, but again, the calls for $100 crude oil have gone away, but we do expect to see some sort of recovery should OPEC and those non-OPEC countries that are participating in production cuts also agree to pull back on output. Gasoline markets have dropped as well. Gulf Coast spot CBOB, that's the blend stock that's before blended with ethanol, has dropped to some of the levels since midsummer of last year in the low 130s. Ethanol prices have also dropped significantly in Chicago. Ethanol prices are at a multi-year low. All that has conspired to help bring retail gasoline prices lower. In fact, retail gasoline prices currently in the 252 area are just a couple pennies above the lows for the year. And at the same time, the spread between 2018 and 2017 has come in significantly. In fact, the current price is only about 2-3 cents higher than what it was at this time last year. For perspective, that spread between 2017 and 2018 at times, basically during the summer, was almost 63 cents. So that number has really come in. At the same time, refinery margins look to be a little bit weak, especially for gasoline, but even now for diesel to a lesser extent. But the one class of trade that appears to be doing well, though, are marketers, as rec to retail margins, according to OPIS data, are really strong in the 40 cents plus area. They've had a really strong fourth quarter, and that's kind of made up for some weakness in the first half of the year.